if you put £4,000 into a lifetime individual savings account, LISA, then you can get £1,000 from the government from doing nothing. So a lifetime ISA, which stands for a lifetime individual savings account, is basically an account, a bank account, that you can use to save up for either retirement or when you buy your first home. There are different providers for a lifetime ISA, and whatever amount you put into, so if you put £1,000 into it, the government then puts in 25% of the amount you deposited. So with £1,000, the government will then put £250 into the same bank account, and in a tax year, the limit is up to £4,000. So in 1 year, I can only put up to £4,000 in my bank account, and then the government will put in £1,000, which is 25% of £4,000. So I'll have £5,000 in my bank account. So why would the government want to do this? Why would they put 25%? It's because it's a way to help people to save up for their first home, because it's kind of expensive right now with property prices rising, or they're really quite high. So it's a way to help people to get onto the property ladder, or you can save for retirement. So in order to get a lifetime ISA, you have to be at least 18 years old and up to 40 years old to open an account. The catch with the lifetime ISA is that once you put the money in, if you take the money out of the bank account, then you have to pay 25% back to the government, or like you have a fee that you have to give because you're taking the money back, because the 25%, you give back 25% because that's how much the government has put into it. It's basically, the account is for you to just have permanent savings without taking money out of it, because if the government gives you 25% and then you just take all the money out, you've just got a 25% return to your money without literally doing anything. But that money's actually meant to be used for retirement or buying a house. So that's why if you want to take money out of your lifetime ISA, you have to pay 25%. So there are different kinds of lifetime ISAs. There are stocks and shares, and the second one is a cash ISA. So a stocks and shares ISA is you put money in, you get 25% of how much you put in, and then the money is actually used is put into the stock market. So depending on who you have a lifetime ISA with, they will manage your money if that's the option you choose, because there are various options within that. For example, I have one lifetime ISA, which is stocks and shares, and I have it managed by a company. I also have to pay management fees for that. The thing is, with the stocks and shares lifetime ISA, you can get good returns, especially in the long term. But you have to know that if you put money in the stocks and shares lifetime ISA, then the money could decrease in value because it's invested in the markets. For example, for me, when I opened my lifetime ISA a few months ago for the stocks and shares, the market was doing really well, so I was having around £50 return, just within a few days. So that was really good. But now, recently, the market hasn't been performing as well, so now it's a loss. There's a decrease in the value of the money I initially put in. However, I know that I'm going to be holding this lifetime ISA for a long time because I'm going to use it for my retirement. So I don't really have any qualms or worries about the money going down, because for me, I'm happy with the risk. And I know that in the long term, the value of my money will increase. Then you have a cash lifetime ISA. So you just put money in, you get the 1,000 or 25% from the government, and then it just stays there. Usually most cash lifetime ISA providers do have a interest rate that they give, but it's quite small. So cash lifetime ISA is useful if you know that you're going to be buying a property soon, because you know that the value won't go down in the short/medium term. Whereas the stocks and shares one, it's more of a long-term investment, basically. So why would you get a lifetime ISA? Well, one, it's a good way to save up for retirement, especially at a young age. If, for example, if you can open a lifetime ISA at 18, if you have savings or any kind of money that you're not going to be using to spend, then you put the money in, you get 25% from the government. 25% is basically 25% return to your money, and you're not doing anything about it, you're just putting the money into an account. And the only thing is you can't take it out, but that's fine because you're saving it for either buying a house or your retirement pot of money that you know that it's there and it's untouched. And in any case that happens, if you're not buying a house or for retirement, if you do need to use the money, it's there and you have been getting 25%. With the 25%, it's with the money you put in each year. So if I have 4,000 I put in my first year, I get 25% at the end of the month, and I get 5,000. In the next tax year, they won't give me 25% of 5,000. They will give me 0 if I put nothing in. So they give you 25% of the additional money you put in. So in year 2, if I put 2,000, they'll give me 25%, so they'll put 500 into my account. They won't do 25% of the cumulative total of the money in your account. There's a range of companies that provide lifetime ISA accounts, though the majority of them, like, there aren't many traditional high street banks that do them. I'll have a more comprehensive list of companies that provide stocks and shares / cash lifetime ISAs down below, but some examples include Moneybox, Nutmeg, Hargreaves Lansdown, Foresters Friendly Society. The reason you can only put 4,000 into a lifetime ISA is because there is something else called an ISA, which is an individual savings account, and there are multiple ISA accounts such as stocks and shares, cash, and then you also have junior ISAs where the parents or guardians use their money to make an account for their child, and then innovative and finance ISAs. So in 1 year you have a limit of £20,000 for your individual savings account limit for savings, and £4,000 from your lifetime ISA is part of that limit in 1 year, 1 tax year. But there are 4 main ones, which are the cash ISA, lifetime ISA, stocks and shares ISA, and innovative finance ISA. And the basic definition of an ISA is that you don't pay tax on the interest on cash in an ISA, and you don't pay any capital gains or income tax on investments from investments in those ISAs. So that's the advantage of an individual savings account. So the limit means that you have £20,000. If you have £20,000 left to spare, you can put, say, 4,000 into a lifetime ISA, you get 1,000 extra, and then so you then have £16,000 left, and then you can split those into the other kinds of ISA accounts you have, so cash, stocks and shares, and innovative finance. So in 1 tax year you can put £20,000 and split it into those 4 accounts, but you can't open more than 1 of each account in 1 tax year. So you can't open 2 lifetime ISAs in 1 tax year, but you can open a lifetime ISA, and then a cash ISA, and then a stocks and shares ISA, and then an innovative finance ISA. You can open 4 of those in 1 year and put money into those accounts, but you can't open 2 of the same.